Hey, everybody. Today we have better than Beyonce, better than Madonna. We have Jay, just Jay, known by one letter. If you're in the real estate business, you probably know who I'm talking about. He's been very prominent in social media, Bigger Pockets, and elsewhere. We're very happy today to welcome Jay Scott to the show. Jay, how are you?
Hey, I'm doing great. Thanks for having me, Jonathan. Glad to be here.
Absolutely. So give me, just by way of introduction, sort of the 30-second snapshot of where you are right now. I mean, I'll dig into your backstory, but sort of like if you had to tell somebody, what is it that Jay Scott does in 2023? What is it?
I am a multifamily investor, so focusing on large apartment complexes, mostly syndication, and our target markets are mostly in Texas, with Houston kind of being our main market. So we buy, reposition, syndicate large multifamily, mostly in Houston, Texas.
And you've done quite a bit of this. I mean, your bio that you sent over says you've done about $150 million worth of deals thus far.
Yeah, so I started out in single family between 2008 and 2018. We flipped about 450 houses. Burned out on single family, almost left the business. I come from a tech background, so I thought about going back and doing some tech work, but kind of got drawn back in because I needed a place to put my own funds. And I don't really trust other people with my money. And so I asked myself, what asset class, if I had my druthers, would I want to be investing in? And realized multifamily was that asset class. And so decided that I would focus on being an active multifamily investor, and which would allow me to invest my funds alongside my passive investors and kind of be my own LP.
So what you said now was really interesting, and it's not, I'm sure, what you're expecting me to say. So you said that you got really burned out and you almost thought about leaving the business. So tell me what happened there, because I know that this is like, burnout is a real challenge for entrepreneurs, and it is not limited to, like, I think there's a lot of people think like, oh, well, real estate never happens to real estate entrepreneurs, but that's not true. So tell me about what happened when you experienced burnout.
Well, it's interesting because one of the things people often ask me, why do I think I was successful in single family and real estate in general? And so I attribute that to the fact that I got into this business knowing essentially nothing about real estate. I'm a business guy. I come from the corporate world, ran some large businesses in the tech industry for some other companies. And so when I got into real estate, what I knew was how to run a business. I knew how to manage pipelines, how to manage employees, how to deal with cash flow, how to deal with all the things that you think of as typical business owner type skills. And so when I got into real estate, because I didn't know anything about real estate, I didn't know about the renovation side of things. I didn't know about literally how to buy. I bought my first house in 2008 when I was 36 years old. And so I didn't even know the process of buying a property. And so it really forced me to get good at real estate by focusing on growing a business and hiring people that were good at all the things I didn't know how to do, and focus on scaling by, I know it's cliche, but by focusing on the business, not in the business. And so that allowed me to kind of scale relatively quickly. It allowed us to get to flipping 10, 20, 30, 40 houses a year. But the problem is flipping is a really tough business to scale, even if you're good at it. What we tend to find is that things kind of go in step functions. So doing one house at a time is not that tough, and doing two houses at a time is a little bit tougher. And doing between 2 and 5 is about the same. But then when you get to about 5 at a time, well, then you need to kind of change your systems and processes, and you kind of step up to the next level, and you have to create new systems and processes for between like 5 and 15. But then when you get to 15 houses, everything changes again. And so you get to these step functions, and as you continue to grow, you need to continually revamp your systems, revamp your processes, and figure out new ways to scale. And at some point, things start to break. And there are people that have done it a lot better than I have, that have been able to get to 100, 200 houses a year. But for me, I found myself just working way too hard, getting frustrated at some of the things that I wasn't able to scale. And so the obvious solution for me at that time was just step out of the business and find something else.
Can you give me an example of some of the things that were breaking down, or things that you weren't able to scale because, just like you said?
100%. Yeah. When I started in 2008, the easiest part of the business was finding contractors. So most of the bad contractors had gone out of business. Most of the good contractors were starved for work. And so you find a good contractor, you basically tell them you're going to be doing 2 or 3 or 5 projects a year, and they're excited because they don't have any other work. They're thrilled to have consistent work. They're going to be very loyal. They're going to give you reasonable prices. They're going to give you good quality, consistent quality. That stopped happening around 2014, 15, 16 as the market picked up. Everybody was flipping houses. Everybody was buying rentals. Homeowners were flush with cash and were doing remodels. And no longer was it easy to find contractors that were willing to basically commit to doing multiple projects with you, to commit to consistent pricing. I mean, basically every project, as costs went up and prices went up, every project got more expensive. And so it was very difficult to scale the renovation piece of the business. Turns out other parts of the business were easier to scale. The financing piece, both debt and equity, got easier as people had more money. 2014, 15, 16, there was a lot of money floating around. Debt was a little bit easier. I obviously had more of a reputation, so it was easier to raise money on the equity side. But then we ran into the issue of, it was really difficult to find properties. Again, 2008, it was easy. I could go onto the MLS, I could throw a dart at the MLS, and whatever it hit, I could probably negotiate a reasonable price for an REO to flip. But by 2014, 15, 16, I mean, finding 20, 30, 40 deals a year to flip was really difficult. We had to do our own off-market lead generation. We had to basically hire people to be on the phone 8-10 hours a day talking to potential homeowners to buy their houses. And we just couldn't scale the acquisition side of the business, at least not to the point that we were comfortable. We've always been pretty conservative in the deals we bought, and finding these good deals that met our criteria got very difficult. And so, yeah, in any business, in any flipping business, I kind of see it as 4 pieces. You've got the acquisitions, you've got the renovations, you've got the fundraising, and then you have the disposition on the back end. And at any point in the market cycle, typically 2 of them are easy to do and 2 are difficult to do. And what we found was that the 2 that were difficult to do in 2014, 15, 16, again, the acquisition and the renovation pieces got very difficult. And so we ran out of runway to scale.
And when you talk about sort of burnout for yourself, what was it that you were doing that sort of caused you to burn out, right? And I mean, were you like handling too many pieces of this puzzle yourself, or was it too much like you're burned out because you're just pushing, and you can't find the deals, and you have like this frustration building up?
So I'd say if I had to characterize the biggest thing that led to burnout at that time period, it was managing employees. So I talked a little bit about the step functions in the business. The biggest thing that changes as you scale is that you have to put in more layers of management. So when you start out, you can be managing the contractors yourself. At some point, you're going to want to bring in a project manager to manage the GCs. At some point, you're going to have multiple project managers. And then when you have multiple project managers, at some point, you're going to need somebody to manage the project managers. And so you get levels of management, and every level of management comes with its own frustrations, its own level of risk, its own level of inefficiency. And so what you find is, it's easy to manage one person. It's hard to manage somebody who's managing people, and it's really hard to manage somebody who's managing people who are managing people. And so to stay efficient, you need to build more and more management every time you add a layer. And unless you have a really trusted group of people that can scale and continue to grow that company from a management perspective, it all kind of falls on you. And unfortunately, what we find in the real estate business is it can be a very low barrier to entry business. A lot of people that come into this business who are here because they think they have an opportunity to get rich quick or get rich easy. And so it can be hard to find people that are talented and disciplined and motivated, that show up every day, that make good decisions, and that have the company's best interests at heart. And so again, around 2014, 15, 16, that whole process for me at least started to break down because it was hard to find those people that I really trusted to help build and continue to scale the company.
And so moving just back in time a little bit, just sort of last question I want to ask about this before we get into the multifamily is, you mentioned kind of at the outset that that one of the skills that you brought from your prior business career was that you knew how to like operate a business, right? In the sense that you knew how to put the right butts in the right seats, that sort of thing.
Yep.
Obviously, those people need to be paid. So I know a lot of people when they're getting into this business and they realize like they can't do this all themselves. How do I do it? How do I bring other people in without really having the income yet to pay them? How do you do that? I'm loading a lot into that question. I know.
Yeah.
How did you do it? Did you have funding to do it? Did you bootstrap it? Like, what was the method by which you were able to get those people onto your team in the early days?
So I was fortunate that I came out of the corporate world with a little bit of cash. So it was probably a little bit easier for me than for a lot of people. But that said, everybody is in a position to do that. I think people need to get into the mindset that there's lots of ways to bring on help in your business. And it's not just full-time employees. In fact, I would argue that full-time employees are kind of a last resort for most startup real estate and business owners, because they do require a lot of overhead, both in terms of financial overhead. I mean, you have to pay payroll taxes, and sometimes you have to give benefits, and there's just a lot of overhead with managing just the paperwork side of things. And then there's the responsibility for managing another person's livelihood. I mean, knowing that if you can't continue to pay somebody, or if you can't continue to pay them what you previously paid them, that can affect their ability to put food on their table. So full-time employees, obviously, as you grow a business, are very important. But for most of us, when we're starting out, there are better alternatives. And so what are those alternatives? Well, it's everything from part-time employees. So people that we're paying just like full-time employees, but instead of 40 hours a week, we're paying them for 30 or 20 or 10 hours a week. They're still on payroll. We're still directing them what they're doing. We're providing them the tools to do that. The IRS classifies them as employees of the company. But then the next level down is contractors. And so we tend to think of contractors in terms of the people that renovate our properties. We call them contractors, but there are a lot of places in our business where we can leverage contractors, people that are not on payroll, that we're paying them, but we don't have to pay payroll taxes. We don't have to provide them tools. We don't have to provide them benefits, things like that. And so everything from your real estate agent, that's a contractor, your title company, that's a contractor, but even things like a personal assistant or a project manager, or people that are more intimately associated with your business on a daily basis. But again, they have the flexibility to be working with other investors, or they have the flexibility to be a consultant and be working for you while they're working for whoever else. Maybe they have their own business. So contractors are huge. And again, not just the people swinging the hammers on your deals. Then partners are great. I'm a big fan of partners, and most of if we ever got into the discussion of like things that have gone wrong in my professional life, most of it has been around partners. But at the same time, the thing that's allowed me to scale the most, and we'll get into this when we talk about multifamily, has been partners. And so by being smart about bringing people into your business that can share both the business responsibilities as well as the financial responsibilities as well as the liability, that's huge. So if you can't afford to pay somebody, if you can't afford even to bring in contractors, bring in a partner. Bring in somebody that you give equity to, who can basically help you with all the parts of your business in return for some vested interest in the success or the failure of the business. Then you have things like VAs. So, I mean, for $6, $8, $10 an hour, you can have somebody from around the world, or people around the world that are performing a lot of the tasks that we as real estate investors need to perform, whether it's pulling lists, whether it's making phone calls, whether it's dealing with emails or calendars or scheduling, whatever it is. There's a lot of things that can get done for a very low price these days, simply because we have this globalism and this technology called the internet. So there are a lot of ways to start bringing people into your business early on to help you grow and scale, even if they're not full-time employees. And I would encourage everybody that if you think the time is right to start bringing people into your business, think about those alternatives to full-time employees when you bring on the first few people.
I've heard a lot of people talk about as well, and I wonder if you've done this too, bringing in people on a kind of success fee basis. Like, for instance, you need help underwriting because you just can't keep up with the
Yep.
deal flow. So you bring somebody in and say, hey, look, I want you to underwrite all my deals. And when we do a deal that you underwrote, I'm going to give you a piece of the GP, on that deal. Is that something you've also
Yeah,
experimented with, or, and
yeah.
if so, how has it worked?
Yeah, I guess that was the last piece that I skipped over. I should have mentioned, but yeah, essentially a commission-based structure.
Hmm.
And whether that commission is, and in the multifamily world, if somebody were to bring me a deal, I basically, there's different ways to pay commission. I could give somebody $100,000 for bringing me a big deal. In the multifamily world, they can take that money, walk away, and come back to me next time you find a great deal, or they can come on and join the team, and their commission becomes, like you said, equity in the deal. They become part of the GP. Maybe I give them 5% of the GP or 10% of the GP for bringing the deal. Now, not only do they have some vested interest in the success of the project, but they are, to some degree, part of the team. They get to learn from everything we're doing. Maybe they want to learn more than just finding deals. Maybe they want to learn how to manage the deals or raise money or construction management or whatever it is. They now are part of the team, and they can get more experience in addition to owning the equity. So it's really a win-win. So yeah, that's the last piece of the puzzle that I should have mentioned, but commission is huge.
So let's talk about the multifamily piece now. I think we've exhausted this topic of the single family stuff. So, tell me about the transition into multifamily, how you got started there.
So I'm a big believer that a lot of things in real estate can be learned through reading and watching others and just paying attention. But when you get into things like multifamily, where the deals are much larger, and more importantly, when you're taking other people's money, when you become a fiduciary and are responsible for other people's money, I really think you need to take kind of a more focused and well laid out plan towards growth and learning. And so what I encourage a lot of people to do is kind of the path I took if you want to get into multifamily, which is I reached out to a couple of the people that I knew that were in the business, and one person in particular, and I said, hey, I'd love to learn this business. I don't expect you to just give me lots of time and energy and teach me for nothing. But maybe we can make a trade. Maybe we can provide value to each other. And basically I reached out to my friend, Ashley Wilson, who had been doing multifamily for a few years at this point. And I said, look, this is what I'm willing to do. I'll give you a year of my time. You get my time, you get my knowledge, you get my effort, you get my money, you get my Rolodex, whatever you need for the next year. All I ask in return is that you let me shadow your team for that period of time and learn the business. And she thought it was a great deal. Obviously, I suggested it, so I thought it was a great deal. And so for the next year, basically, I became part of her team, unpaid, though we did end up doing a deal a few months later that I helped in several aspects. So I ended up getting equity in the deal. And what we realized after a year was we had a tremendous number of synergies. We had a tremendous number of complementary skills, Ashley and myself, where between the two of us, we could really cover all aspects of the business. And so we ended up partnering. And the rest is history. We've been partners for the last 3 or 4 years. We've done a lot of deals together. But the beginnings of that was really me saying, I need to learn this business from somebody that knows the business, and being willing to trade value for value in order to get that experience and knowledge.
And what were the kinds of things that you were doing during that year? I mean, obviously you weren't just following around doing nothing. You were, I'm sure you were
Sure.
trying to contribute something. So
Yeah.
what were you able to contribute?
Well, so I have some skills that were valuable in the multifamily world. I have the ability to raise money, so that was number one. I had a good Rolodex of investors that I had worked with over the years that would have been happy to invest with me, but I never really had anything for them to invest in. Also, I'm an engineer by education, so the numbers part of the business has always come easy to me. And once I learned how to do multifamily underwriting, being able to create financial models and spreadsheets and really improve their underwriting methodology became an important role in the business for me. And likewise, just being able to run the business. So being able to create systems and processes around the accounting and the payroll and hiring and the legal and compliance work, basically all the grunt work that is super important, but you typically hire out. creating systems and processes around that. And so that's kind of what I focused on during that year in helping the business. And at the same time, I got to learn all the pieces of the business that I knew nothing about. So acquisition and due diligence on large multifamily and the debt side of the business. I knew the equity and the capital raising side, but I had no idea how debt worked in the commercial world. And then most importantly, asset and construction management. I mean, I know we don't talk about this a lot in newbie spaces because people don't really care about the asset and construction management until after they find a deal, and nobody's thinking that far ahead. Everybody wants to know about how do I find deals? How do I raise money? But the reality is the most important part of any deal is the asset management, the construction management on the back end, because that's where the money's made or lost. And so luckily I hooked up with a team that's really good at asset management. And so I got to learn that side of the business as well. And so, yeah, so I was able to contribute a lot, but I was also able to basically see the inner workings of a large multifamily group that was doing real deals.
And so what is your role now in that business, and what's the division of labor between you and Ashley?
Yep. So it's funny, we treat the business, at least from a conceptual standpoint, as two separate businesses. I am responsible for, I'll say, the capital raising and the equity side. I'm also responsible, again, for all the systems and processes, the financial models. I run the analyst team, the compliance and legal work. But for the most part, my biggest job is to raise money. Ashley's responsible for everything on the ground. So she's responsible for acquisitions, due diligence, asset management, and construction management. So basically finding the deals, managing the deals, and making sure they're successful. And so we kind of treat these as two separate businesses because they really could be. She's responsible for everything related to finding great deals and running them. I'm responsible for everything related to funding those deals. In theory, if I'm much better at my job than she is, I have too much money, I could always go out and we could fund deals for other operators. Likewise, if she's much better at her side of the business than I am, she's going to find more deals than I find money. And then we have to go find other capital raisers or institutional investors and bring them in to fund the deals. But for us, it's very much like we're always competing. And I want to be better at the business than she is because I always want to have more money than she has deals. So I can say to her, oh, you don't have enough deals. I'm going to go find another operator we can fund. She wants to be better than I am because she wants to say, hey, you can't fund everything that I'm finding. All these great deals. I'm going to go find somebody else to fund it. And so we're constantly competing with each other to kind of make sure that our sides of the business are growing in sync. And so for us, it's been a great synergy because she's really good at her side of the business. I'm not good at that side. I'm really good at my side of the business. She's not good at that side. And so we just complement each other so well.
I mean, this is such a great point, and it comes up repeatedly on this show that like the key to being successful in this business, and really in any business, is finding people who are good at each function and having them do it, right? Rather than trying to do everything yourself, or everybody trying to do, what they consider to be the sexy thing or whatever, you're not going to be successful unless you find somebody like, you who's passionate about the capital side of things, and Ashley who's passionate about the real estate side of things, and you can work together synergistically rather than both trying to raise capital, both trying to do deals, or, somebody who's just not in the right fit for them, because, well, I'm really good at finding deals, so therefore you must be the capital raiser guy, whether you like that or not. I mean, I see a lot of partnerships like that, right? And they don't work as well as something like what you guys have come up with, right?
Yeah, the biggest misnomer I see for new investors that are looking to jump into a partnership is they think they need to find somebody exactly like them because they're going to get along great and they're going to do big things. So I come in and I don't have a lot of cash, but I'm super motivated. I know the numbers. I'm really good, whatever it is. And they find somebody else who's exactly like that. Somebody else who's not very knowledgeable, but they really know the numbers. They don't have a lot of cash. Oh, we're like brothers. We're so alike. Let's partner up. It'll be amazing. And in reality, what we should be looking for is somebody that's completely different than we are. Not necessarily from a values perspective. It's really important that we're aligned from a values perspective and a growth perspective and where we want to be in the future. But from a tactical perspective, we want people, or we should want people, who are completely different than we are. Because the goal is we're building a business. And so a business has a lot of moving parts. I need people that are good at all the things I'm bad at, and I need to be good at all the things they're bad at. And sometimes it takes more than two people. I mean, in the multifamily space, what we often find is finding deals, acquisitions is a full-time job. And somebody that is really, really good at acquisitions may not be good at anything else. Likewise on capital raising, somebody that's a really good capital raiser and good at investor relations and good at like branding and really representing your company well, that's a full-time job. And you may not be good at anything else. Likewise, asset and construction management, we talked about that. It's often overlooked, but literally the hardest part of the job. And instead of just saying, okay, we'll kind of fill that piece in with all the other people in the company. No, you need dedicated people that are really good at asset and construction management. And so in any given multifamily company, you at least have those three roles. And it's very rare that you're going to find one or two people that can cover all three roles completely effectively. So it's normally at least three people.
Yeah, and I think it's also, I mean, sort of two further points on that. I think it's really important to have a personality balance as well. Like, you need somebody who's like really outgoing and really optimistic, and you need somebody who's maybe more introverted and maybe a little bit more like, hey, whoa, put it, slow down there, partner, a little,
Yep.
because if you don't have both of those things balancing each other out, you wind up either, people get too, tunnel vision and they're entrenched, or everything is a great deal and they have no perspective. So you need to have that kind of back and forth on things. And then the other point that I wanted to make too, in reflection of what you've said, is that I think it's very hard for people who are new to understand that there are people who really love to do the stuff that you hate to do, right? It's very hard to imagine that. So you think everybody wants your job because, well, it's a great job, you love it, right? And you don't want to give that up. And
Yep.
you don't want to partner because, well, they're going to be after your job because the other stuff sucks. It's really not true. I mean, there are people who are just as passionate about the capital raising side or the deal finding side or the asset management piece as you are about whatever your role is.
100%. Absolutely. Going back to the thing you mentioned earlier, just when it comes to making decisions and pushing the company forward and having different levels of risk tolerance and different levels of not different levels, but different goals and desires for the business. What we found is that even having two people, Ashley and myself, isn't enough because we're very different. She tends to be very visionary. She tends to be very aggressive and less risk averse. She's 10 years younger than I am. I'm older. I'm more risk averse. I tend to be more conservative. I tend to say no to things as my natural reaction, as opposed to her tends to say yes to things. And if it were just the two of us, and we each had 50-50 vote, we've never settled anything. And so what we found is, for us, we kind of have a board of directors. We have two other people that we consider principals in our business. Their name isn't on the marquee, not that we actually have a marquee, but when we talk about the business, it's Ashley and myself as partners. But there are actually two other people that are partners in the business that are kind of behind the scenes. And essentially their role is board of directors. They're the mediators. And when we have to make big decisions about whether it's buying a property or whether moving into a different asset class or moving into a different market, or if we run into a problem in the business and we need to brainstorm solutions, they come in and they have as much say in those overall decision-making functions as Ashley and I do, because a lot of times having people that aren't as in the trenches that can see at a higher level, the 10,000 foot level, is more important than Ashley and I trying to make decisions when we're really vested in the day to day and we can't necessarily see the big picture.
So you mentioned before, and I couldn't leave this alone, that you said some of the sort of worst things you've had to deal with in your business have been partners. Right now, clearly you found a partnership that works, but it's pretty unusual the first go out of the gate to find a partnership that really works. So, and I've had partnership breakups myself. I mean, almost everybody I know has been through partnership breakups. So tell me a little bit about, what was behind that kind of throwaway line a few minutes ago.
Yeah. So, I mean, I've had a lot of partnerships and I've learned a lot about myself in those partnerships. I've learned about other people in those partnerships. I've learned, for the most part, what are the things that you should be looking for up front that are either red flags or yellow flags about a partnership that's not meant to be, or green flags, I guess, that a partnership is likely to work out. In terms of some of the bad partnerships I've had, I got into a flipping partnership back in 2012, 13, where we literally flipped 50 houses in a city that was equidistant from both of us. He was in Arizona, I was in DC at the time, and we decided to flip houses in Milwaukee. And at the time that seemed great. It's equal distance for both of us. Well, yeah, it was still a 3-hour flight for both of us, which meant that neither of us were excited about having to travel. Again, we were very different in terms of our risk tolerance. He tended to be more aggressive and have a higher risk threshold than I did. And we didn't know each other particularly well when we jumped in. It was very much a case of we were doing the same thing. We had similar backgrounds, exactly what I said before. We were very much alike. And so it seemed like, okay, this is a perfect partnership, when in reality, being very much alike was probably the thing that was like the worst combination for us. And so that partnership didn't go anywhere. At the same time, I met somebody back in 2010 who came to me and basically said, I want to learn to flip houses. I'm not going to ask you to just teach me the business, just like I did with Ashley. I'm not going to ask you to teach me the business for nothing, but here's the deal. I got lots of cash. What I'll do is I'll offer to fund every deal you do for the next year, if you basically let me shadow you for the next year. And he did. He funded every deal I did for the next year. I didn't have to go to the banks. He learned the business. I just mentioned that we have a board of directors on the multifamily side. He's one of those people that's on our board of directors. We've been working together for 10 years now. We've done $100 million in deals together. 75% of the property that I have an equitable interest in, he has an equitable interest in as well. Like everything we've done for the last 10 or 12 years has been together. And that's been an amazing partnership. Likewise with Ashley, because we have such complementary skills, it's been an amazing partnership. So I value great partners, but I tend to be, again, pretty conservative these days because I've been burned a couple times about the types of people I get into a partnership with. And so some of the questions I want to ask are, one, how well do I know that person? So a lot of times we tend to jump into partnerships very quickly, but a partnership's a lot like a marriage. Like you're not gonna ask somebody to marry you after a first date or a second date. If anything, partnerships sometimes last longer than marriages, because with marriages you can go in front of a judge and split up assets. With partnerships, sometimes it can be really difficult to split up assets before the natural progression. So that's number one. Number two, just sharing the same values is absolutely huge, because partners are people that you're going to spend a lot of time with. And if you disagree with them, anything I'll bring up, I mean, it's ridiculous, but if you have different religious beliefs, if you have different political beliefs, if you have different ethical beliefs, super, super important that you have the same ethical beliefs.
That's probably the most important one of all. I would
Absolutely.
say. Yeah.
Absolutely. Because what do we have in this business? At the end of the day, all we have is our reputation. And if somebody is going to compromise your reputation because they don't care about your reputation as much as you do, I mean, that can ruin an entire career. A bad partnership can literally ruin your entire career. So having like a commonality is there. But here's another thing that a lot of people don't think about. If I said to you, hey, Jonathan, let's you and I partner, and we never talk about what our financial goals are, what's the risk there? Let's say you and I decide to get into a business partnership, and you're sitting here thinking, okay, my goal is to make $10 million a year. And I'm sitting here thinking my goal is to make $1 million a year. Both pretty good goals. We should both be pretty happy, right? Well, let's say we kick off that business. In the first 6 months, we do an amazing job of growing this business. We make $1 million. What's happened? I've achieved my goal. I made my $1 million. What am I going to do for the next 6 months? I'm probably going to go sit on a beach somewhere and say, hey, let's celebrate and we can do it again next year. You, on the other hand, are thinking, well, I'm only 10% to my goal. I want $10 million. Why is this guy like off vacationing and celebrating when we're only 10% to our goal? And so I see a lot of partnerships that fail because there isn't an alignment on what success looks like. One person is happy with a lot less than the other person. And then when they achieve that lesser amount, they're kind of off in the wind, and the other person's frustrated because they're still trying to achieve their goals. So that's huge as well. A couple other things that I think are really important in partnerships. Number one, if you and I are going to partner, I need to be comfortable working for you, because there are going to be situations where you're going to own some piece of the business and you're going to need to delegate things to me. And if I'm not comfortable saying I'm willing to work for Jonathan, we're not going to get along well. Likewise, you need to be willing to work for me, because there are going to be pieces of the business that I own. And if you're not comfortable being delegated to from me those pieces of the business, you're going to get frustrated. And so you have to have enough respect for each other that you're willing to be subordinate to that person at different times and in different parts of the business, because in any partnership, you're going to be working for the other person 50% of the time.
Yeah, those are both really good points. You'd mentioned something a moment ago, I thought I heard you say about red flags. What are red flags for you when dealing with somebody who, as a potential partner?
Yeah, and I think it's basically all of those things that the inverse of all those things I just discussed. If you don't have a history with somebody, that's a reason to slow down. If you don't share common vision or personality, well, not necessarily personality traits, but like we said, ethical beliefs and other personal beliefs. If you don't share those things, and one of you is much more adamant. We know the political climate these days. If one side's a staunch conservative and one side's a staunch liberal, and either side can't handle the views of the other, that's going to be a problem. Likewise, I mentioned if you can't work for the other person, that's huge. I'm also a big fan of, at the end of the day, there's really no 50-50 partnerships. I mean, there can be 50-50 equitable interest. You can own 50% of the business. I can own 50% of the business. But for a two-person business to run effectively, somebody needs to be in charge. Somebody has to have the final decision-making ability. And oftentimes we designate that person as the CEO, but it doesn't matter what the titles are. But the two people need to come together and say, at the end of the day, if you and I are in a partnership, Jonathan, either you're making the final decisions or I'm making the final decisions. And there are a lot of people that don't like that idea of being a 50-50 partner, but not having the final say. So that's another red flag for me. If we can't come together and say, Jonathan, I'm comfortable with you making the final decisions on everything, then it's not going to work. And so that to me is another red flag. People need to be willing to relinquish. Somebody needs to be willing to relinquish that control.
Yeah, these are all good points. I remember on one of my early partnerships, sort of after we had decided to become partners, I remember the very first time I went to like the office that my partner was renting, and I walked in and there was a picture of a celebrity that I absolutely loathed. And like, not just that I didn't like them, but just like I didn't like what they stood for. And there's like a picture of this person as like a hero to be venerated. And like that gave me this really bad feeling right off the bat. But I was like, well, I just started this thing, so I've got to dive in. And lo and behold, ultimately the partnership broke up because we didn't have the same sort of ethical values. Actually, yes. That's what it, not that person was unethical, but just we had very different like ideas of how you treated investors and things like that. So and that's where it foundered ultimately. So those little things are clues. I mean, you probably want to go visit their office before you partner with them.
Yeah, and I mean, talking about visiting somebody's office, I mean, when we talk about a marriage, what's the biggest thing that comes between two people in a marriage? It's money. And we see the same thing in a business. If you and your partner don't have the same values when it comes to money, what you spend your money on, one partner may want to take the profits and like buy a big office building as just like kind of a vanity type play to say, hey, look at this huge office we've got. The other person wants to work out of their garage because they're trying to save money and be fiscally responsible. I mean, those two people are going to run into an issue at some point when it comes to decision making around money.
So let me ask, I mean, this has been really fast. This has been a great conversation. We're already kind of up against our time, but I want to ask you, what is the hardest thing you've had to overcome in your business?
Oh, that's a tough question. For me, it's probably the fact that I'm a tremendous introvert. People don't recognize that. Like, and I guess sitting here talking to you, probably don't see that. I've done a really good job over the last 10 or 15 years of kind of hiding that for short periods of time. But the reality is that this is difficult for me. Talking to people that I don't know, going into a room of investors, talking to a potential investor in a deal, getting up and speaking in front of 200 people or whatever it is really, really tough for me. But I've also recognized that the business that I'm in, I'm going to be more successful if I have the ability to do that, whether I'm raising money, whether I'm speaking, whether I'm doing whatever. I'm going to be more successful if I can portray an extroverted personality. And so the hardest thing for me is I have to act a lot differently than my brain
naturally to you. Yeah.
Yes, exactly. And so overcoming that over the last 15 years has probably been the hardest thing for me, but it's also helped me grow tremendously.
And how did you do that?
I think it's really just, it's forcing myself. It's no different than anything else. Like, I don't like going to the gym. And I probably don't go, if you look at me, I probably don't go as often as I should. But I try and force myself to, because I know I need to do it. I don't like to not eat dessert after dinner, but I know that I shouldn't eat dessert after every meal. So I just have to force myself to do it. And it's the same way with a lot of things in life. There are things we want to do and things we don't want to do. And we know that sometimes we just have to push ourselves to do the right thing, whether it makes us happy or not, whether it makes us comfortable or not. And so for me, it's really just been 15 years of pushing myself out of the comfort zone. And just like everything else, when you do something enough, it does get easier. It's easier to go to the gym after you've gone for 3 months. It's easier to eat healthier after you've done it for a few months. It's easier for me to jump on these podcasts after I've done 300 of them over the last decade. And so, yeah, it's that's how I do it. I just push myself.
And what drives you? Like, what's behind that? Because clearly, if you don't have a reason to push yourself, you're not going to do it. So what's your reason?
It's changed. There's a number of things. From a personality standpoint, I have this need to prove myself. To me, money is a way of keeping score, and deals are a way of keeping score. And I'm very, very competitive. And so to some degree, I mean, it sounds horrible to say, but to some degree, like, this is just my way of keeping score. If I can do more deals and be more successful and make more money, that kind of satisfies that internal need for success and competitiveness for me. From a more tactical or realistic perspective, I got into real estate. My wife and I left the corporate world. We were both in the tech world, Silicon Valley. And the reason we left was because we were working 60, 70, 80 hours a week when we decided to get married. And we knew that we just couldn't raise a family given that lifestyle. And so we got into real estate very much as a way to control our ability to decide when we're going to work, when we were going to have family time. And so a lot of what I've done over the last 15 years has been really to give myself the opportunity to raise my kids and actually be there and be present. And I don't always accomplish that to the degree I want to, but I'd like to think that real estate's given me the opportunity to do that more so than my previous career or most careers would.
Well, on that great note, unfortunately we have to end, but this has been really fun talking with you. I'm glad that I got to know you, and I would like, if people want to get in touch with you, maybe get on your investor list or just learn more about you, what is the best way for them to do that?
Yeah, so anybody that wants more information, wants to get in touch with me, wants to invest, wants to find out anything, go to www.connectwithjscott.com. That's my link tree. It'll link you out to everything you need to know, including my email address.
All right, so connectwithjscott.com. Jay, once again, thank you so much for your time today. Really enjoyed this conversation.
Thanks, Jonathan. Appreciate it.